Hey everyone, happy new year. Welcome back. So today we're going to, we're going to talk about TLC insurance. I know we talk about it a lot, but we're actually going to speak about the TLC insurance broker industry. And with TLC insurance renewal upon us, I think it's an angle of this whole American Transit situation and the rising TLC insurance cost that is not as discussed or hasn't been as discussed, at least in detail. So let's get into it. And so for those who don't know, what we do is we usually draft up an article and then we speak to it. All the links that we go over, we'll provide in the YouTube's table of contents, or we'll provide it in our Substack too. We distribute it both with the video on YouTube and the newsletter and the video on Substack. So the title of this article is NYC TLC Insurance Brokers Face Mounting Crisis Amid American Transit Turmoil. American Transit Insurance Company's technical financial insolvency could significantly impact local mom and pop insurance brokers that service NYC TLC drivers and fleets. Okay. So this is a pretty dense article. It's going to be a little more technical. That's why we put it in our plus section. Like I said before, there's going to be a table of contents so you can skip around in case, it runs long, or, you just want to just focus on specific aspects of what we're talking about. But we always try to aim, we're a long form content platform, but we try to aim to keep it below an hour. We'll try our best. I'll try my best, I should say, today. So just before 2025 started, Bloomberg News published a bombshell investigative report on American Transit Insurance Company, ATIC, as many of you know, the technically insolvent NYC for hire transportation TLC insurer with more than a 60% market share. So this is a very well covered story at this point. So I'm probably going to mispronounce some names, but Laura Namias, Alexandra Rajbandari, Claire Ballantyne, and Natalie Lung's New Year's Eve report, so they publish it on New Year's Eve, December 31st, on ATIC, provides an unmatched look into the history of American transit and the unfolding insurance crisis. Their ongoing coverage, in our view, has become Pulitzer worthy. So the Bloomberg has just really done a really good job with this story. They're just kind of really doing a deep dive into the history and all of that stuff. So the article is behind a Bloomberg paywall, so we can't share too much of its contents. However, the piece delves into ATIC's, American Transit's corporate history, its executives and ownership, the history of executive payouts, and notable historical connections with influential politicians, including former U.S. Senator Al D'Amato, and late, I think they've passed away, former Speaker of the New York State Assembly, Sheldon Silver. Bloomberg also examines the multi-decade history of regulatory interventions. This stems all the way back to 1979, I think, actually, by New York State's insurance regulator, the Department of Financial Services, DFS, as well as the ongoing debate surrounding NYC no-fault insurance PIP limits, insurance fraud, and the influence of the New York State Trial Lawyers Association. Obviously, a lot is covered in this Bloomberg piece. So the story is worthy of a John Grisham novel. If you're not familiar with that author, there's a very famous movie with Tom Cruise called The Firm. And so he's kind of like a corporate suspense writer. So this story, the ATIC story, is worthy of a John Grisham novel, although one that's still unfolding. So there's not a conclusion yet to this story. Who knew insurance could be this interesting? So this is behind a paywall, but we'll provide a link to. So this was the Bloomberg investigative piece published on the 31st. The headline was NYC's taxi mess was driven by decades of inaction and massive fraud. Authorities are struggling to contain the damage from insurer ATIC's insolvency. The company says it's a victim of widespread fraud, but taxpayers, cab drivers, and consumers risk footing the bill. And so, that's behind a paywall. We also will provide a link to, I'd mentioned that PIP point. So there's an article, Wall Street Journal, the editorial board. Again, this is behind a paywall, but we'll provide a link to the article where it kind of spoke about that corruption, or that alleged corruption going on in that market. So it's just it's a very deep story. So we think Bloomberg did a fantastic job with that. So okay, then we write next, blame game. Given that many individuals and institutions were named and shamed. So just to be clear, this Bloomberg article, I mean, this goes into, this person's brother-in-law and this person runs this entity, and it's great reporting, but like it's one of those, like, people are being named, executives are being named, this guy took money, this regulator failed. So a lot of most, appropriate, I should say, naming and shaming, but like this is that sort of investigative piece. So I just wanted to make a point about, that dynamic, and to add additional layers uh, to um, to what went on, and maybe some kind of constructive criticism for Bloomberg, because they kind of don't mention one thing, and so I'll get into that. Given Given that many individuals and institutions were named and shamed in Bloomberg news article, which concludes with former NYC Taxi Limousine Commission Chair Matthew Doss stating, and this is how the article ends, the quote, "It is a colossal mess that could have been prevented if government was proactive instead of reactive. We believe an important disclosure was missing." Excuse me. So we actually don't disagree with that statement. It is true, but I think Bloomberg has to disclose, like, it's kind of weird coming from Matt Doss, to be frank. Nothing against him. We don't know Matt Doss, but this is why we think that's a little bit weird. So Michael Bloomberg, co-founder and majority owner of Bloomberg LP, the parent company of Bloomberg News, served as the mayor of New York City from 2002 to 2013. While the DFS, which oversees insurance regulations and companies in New York, is under the governor's jurisdiction, Mr. Doss served as TLC chair and commissioner during the majority of Bloomberg's administration, having been originally appointed by his predecessor, Rudy Giuliani. As Bloomberg News' investigative piece highlights, the issues at American Transit were well known throughout Mr. Doss's tenure as head of the TLC. He was fundamentally responsible for overseeing NYC's for hire transportation industry at a time when American Transit still had a dominant insurance market share. Additionally, insurers often blame NYC's unique 200,000 no-fault PIP requirement, well above New York State's $50,000 PIP mandate, for uniquely incentivizing fraud, which may partly explain ATIC's dire financial condition and other TLC insurance company liquidations, which we've gone over, with the Bloomberg article goes over. Notably, Park Insurance is a recent example of an insurance liquidation. In other words, Mr. Doss was deeply embedded within the same government he now criticizes for failing to be proactive in addressing issues at American Transit. Despite having the ability to address the situation at ATIC, including the backing of one of New York's most influential politicians at the time, Mayor Bloomberg, Doss's efforts, if any, ultimately proved unsuccessful. If a political appointee with such support could not address or resolve ATIC's challenges in a meaningful way, it likely reflects a lack of effort. We'll summarize all of this. I know this could be dense, but we just want to make this point because it's about fairness, honestly. That's why I'm particularly passionate about making this point. To be clear, we're not implying that Michael Bloomberg or his appointed TLC chair bear responsibility for American Transit's failure. However, we believe Mr. Doss's remarks are in extremely poor taste given his previous role in the government. Current DFS administrators, including Superintendent Adrian Harris, should not be unfairly criticized in the media or by former government officials for addressing and cleaning up a situation that has been decades in the making. In fact, we commend the current DFS and other policymakers for finally taking action that addresses the underlying financial condition at ATIC. That said, the current TLC recently proposed and held a public hearing on insurance rule changes that, in our view, unfairly prevent large fleets faced with clearly limited insurance options from responsibly experimenting with hybrid admitted, non-admitted self-insurance structures. This could help the industry become less reliant on companies like ATIC. Explanation point. Okay, I probably should have stopped there. That was a bit run on, but let me simply explain all of that, or try to simply explain that. And there's relevant article links here. My basic point is that Matt Doss was the TLC commissioner. I think he's the longest serving TLC commissioner, and he was there from, let's say, the early 2000s all the way to 2010, maybe 8.5, 9 years as TLC commissioner, maybe even longer. And so for him to say it is a colossal mess that could have been prevented if government was proactive instead of being reactive, that that is kind of like rich coming from the person who was in charge of the TLC, who could have flagged it to Mayor Bloomberg, who could have brought it up to the DFS. Maybe they did. And if they did, then that underlies the point that even if someone as influential as Mayor Bloomberg couldn't, you know, couldn't force the DFS to take action via his own TLC chair. And NYC also has oversight on NYC TLC, taxi, FHV insurance. Then for him to say that the government's at fault, he was in the government. So I just think it's in really poor taste. And I guess the point of mentioning, who Bloomberg News is owned by is, I respect Michael Bloomberg. He's obviously made an amazing company. He's an amazing entrepreneur. But, you know, it seems like everybody else is being blamed, but and then they're quoting a Bloomberg administration official to like distance themselves from this mess, and then putting the blame on everybody else. So that doesn't sit right with us. Maybe you have a different opinion. Maybe we're being overly critical, but we just wanted to write that because it's a very weird way it's a very odd person to take a quote from and an odd person to criticize the government's inaction, which we agree with, but that person was part of the government. Maybe not directly overseeing ATIC, but they definitely, had influence to, bring up this matter and be more proactive, as they say themselves. Anyways, nothing against, Matt Doss, which I've heard good things about from other people. But it's kind of a disclosure that I think Bloomberg should have made. Honestly, usually, for example, we disclose that we own an NYC TLC fleet, even if it's like a very distant conflict in some cases. What we write about, this is obviously a direct. This should have been disclosed in the article, but otherwise, great reporting. So nothing, the reporting is fantastic. On this last point, that said, the current TLC recently proposed and held a public hearing about insurance rules. So we did some articles about this. And then this is another article about the fraud, and we'll get into that later. But we did an article about this. It was a TLC hearing, and basically it had to do with this. You can read the article. We're not going to go over it. It's kind of complex. We actually did a separate video, which we'll provide a link to, and that's embedded in this article, I believe, as well. But there's self-insurance fleets that have been using this kind of unique self and hybrid hybrid insurance structure. That's what you need to know. If you want more details, you can read the article. But the TLC then proposed rules to act to kind of prevent them from doing that. And what's weird about that is, as the industry is trying to come up with solutions to solve the over dependence on American transit, they're killing a way for the industry to be less reliant on ATIC. So it's like, that's also kind of counterintuitive. It's like a very weird moment to kind of target, uh, you know, target that innovation, especially with a well-rated, AM best rated, like self-insurance fleet captive. I could, in our opinion, in the article, we could understand like preventing non-admitted carriers from servicing maybe individual drivers, but for large fleets, I it should be monitored, but it's a very weird moment to prevent that. So, if our overall points are confusing you, or you want us to clarify that, just, leave comments in the Substack or YouTube. So continuing on, additional thoughts. One of this publication's most notable achievements in 2024 was publishing and detailing the technical insolvency at ATIC before national media picked up on the story. We even got a shout out in a Bloomberg article. We've actually been writing about this topic for some time. The article below is from February 2024. So, and we'll get into it. We're not trying to pat ourselves on the back too much here, but we did flag this issue. And then it was subsequently picked up. But we'll get into that. Actually, like, many people have been flagging this issue for many years. And in fact, Bloomberg's article shows that people have been flagging this since 1979. So, but we did make this article that did make, maybe was the straw that broke the camel's back. So this was from February 2024. We literally have a headline saying, "Is American transit too big to fail?" February 2024. So well before the story got picked up. But to be clear, and again, excellent reporting by the Bloomberg team. Bloomberg obviously elevated the story to a huge audience in a way only a handful of media organizations can. So for all our criticism about disclosures and things like that, Bloomberg should be given tremendous credit for covering the story. And I think honestly, I wouldn't be surprised if this sort of story and this sort of coverage does lead the team to get a Pulitzer nomination, which is a very prestigious award in journalism. So well done to them. But that being said, not even a but that being said, but notably, S&P Global had already been covering ATIC story for years. We're just writing this because this was so I'm going in and out. We're just writing all of this, and then we'll get into the broker crisis, which is the main gist of the article, is because this was like a massive investigative piece, like that I think many people were waiting for. So just kind of summarizing the history of reporting related to this, but then we're going to get into the insurance, the main part of the article. But we just wanted to summarize all the people who honestly should be kind of given credit for flagging this story and the history of reporting and journalism around this story. So I write, notably S&P Global had already been covering ATIC story for years. Tom Jacobs and Terry Leone published, actually says New York livery insurers reserves inadequate by more than 500 million. Now that number is 700 million. In June 2021, S&P Jacobs and Tim Zawacki also published insurance industry overviews that highlighted the dire situation at ATIC. Our contribution in the telling of American transit story is perhaps simplifying it for a large enough NYC TLC specific audience to help bring more attention to the decades-old situation. This included a YouTube video on the subject as well, so if you want to check that out, you can. We kind of describe the situation in technical detail more. But these were quotes from these S&P articles, and this is free to view, not behind a paywall. June 2021. This one is August of this year as well. But like June 2021, like just listen to this quote. Derek Freyhot, apologies of mispronunciation, a principal and consulting actuary for Pinnacle Actuarial Resources, call reports like the one filed by Ronald Coyne, apologies, of Huggins Actuarial Services very uncommon. Freyhot said he and a colleague looked at more than 2,400 SAO reports. I think that's a actuarial opinion report to the NAIC, which I think is an insurance kind of like a organization of insurance commissioners, I think, and found that less than 1% of them stated a company's reserve were not reasonable. Of those 2,400 reviewed reports, only 6 carried a deficient opinion. So S&P back in 2021 is like, this ATIC situation seems like weird. $500 million deficit at that point. So they were flagging it back then. It just didn't get picked up for some reason. Then obviously later this year, just to kind of give context, later this year and much closer to the Bloomberg publication date, when the story got picked up by Bloomberg, and then they elevated to another level and did some amazing reporting, continue to do amazing reporting. Just look at this quote: American Transit Insurance Company, a New York based and focused writer of commercial auto insurance for taxis for hire transportation network company vehicles, that's Uber and Lyft, recorded an unfavorable prior loss and LAE reserve development of 755.8 million in the second quarter, an amount that exceeded 2,900% of its December 31st, 2023 surplus and 145.3% of its March 31st net total asset. This is where, like, just to contextualize S&P, give some interesting context. It also ranks as the largest amount of adverse reserve development booked by any individual U.S. Kind of P&C personal and casualty insurance entity in a second quarter in the last 15 years. That's across the entire American P&C market, which is probably in the, hundreds of billions, if not, more than that, surpassing the 732 million in unfavorable development attributable to the Allstate Allstate Insurance Company, which is obviously a much larger company. So 700 million is horrible, but if they're underwriting, 50 billion or 20 billion of premium at that point, that's still bad, but they're also underwriting, 20 billion plus whatever it was 15 years ago. American Transit's second quarter net underwriting loss of 743.3 million ranked third highest in the industry. American Transit and its appointed actuary have long been at odds over the reasonableness of the country's reserve position. So, American Transit underwrites, let's say, give or take, 300-ish million of policy annual premium. So to have this 700 plus million loss recognition or loss in a quarterly basis, obviously it's catch-up losses, is just gigantic. It's when you contextualize the amount of premiums. Let me make this simple. So if Allstate Insurance, if the previous record was Allstate Insurance of 700 whatever million, but Allstate Insurance is this massive national insurance company, and if they were underwriting 20 billion, obviously 700 million loss development is not good at all, but they're still fundamentally underwriting like 20 billion plus or whatever it is. If a company's underwriting 300 million a year and they recognize a similar loss of 700 plus million, that's insane. So it just gives you more context to how unusual this story is, to be frank. Furthermore, many insurance executives we've spoken with over the past several years, some based in NYC and others operating on a national scale, had long been aware that ATIC was technically insolvent. Most just assumed that neither regulators, both the DFS and TLC, nor politicians, both at the state and city level, would ever take definitive action. It's hard to fault them. Bloomberg's investigative reporting on ATIC's history of navigating multiple DFS interventions since the late 1970s illustrates the insurer's incredible, almost magical ability to consistently escape harsher actions. I mean, here's like a very small quote from the Bloomberg article. In 1991, the state regulator, DFS, swore in an affidavit that the company was running an insurance Ponzi scheme that was nothing less than a time bomb set to detonate the moment ATIC's new premium volume becomes insufficient to fund the payment of prior years' losses. 1991. So that's also to my broader point, not to double click on it too much, but like when, Matt Doss, the former TLC chair, kind of says it's the government's fault, but he was part of a core part of that government that should have flagged this and been more proactive. This was like a well-known issue for decades. So now we're going to conclude and then go into the broker story. Is American Transit still in business? So this is a very important question to answer. So a common question we're seeing on social media, obviously, is TLC insurance renewal season. A lot of policies expire on March 1st. So people are renewing between now and then. Ahead of the busy January through March Q1 TLC insurance renewal season, whether American Transit is still in business. The simple answer is yes, or at least for the foreseeable future. We want to reassure what we wrote in another article about the ongoing ATIC crisis. In a situation where a bank, insurance company, and or financial institution is so dominant that its failure might cause systemic challenges to a marketplace, we want to be extra cautious about how we report and what we're saying. We do not want to plant the seeds for or promote a run on the bank. And I'll briefly explain what I mean. Please read below. First, ATIC is technically insolvent. This is just a fact. We're not being hyperbolic. However, NYC TLC drivers, fleets, and passengers should have full faith that the Department of Financial Services, DFS, New York State's insurance regulator, will ensure liability protections are honored. In simple English, if you're currently insured by ATIC and get into an accident today, you have insurance. Whatever happens to American Transit, the DFS, in effect New York State, guarantees your coverage. ATIC is insolvent, and our opinion is that ahead of the next major insurance renewal period for drivers and fleets, which typically occurs in February, which we just went over, individuals and operators might want to consider other options. As we know, there aren't a lot. There's basically one other option at this point, which is Hereford. Also, NYC TLC drivers and fleets should expect their premiums to significantly increase, although we've recently found out that the increase is actually not going to be that big. How much the increase will be varies on drivers' records, loss runs, of fleet's historical performance, and what the DFS approved. So that was in October. And so then we're going to get into the crisis. I mean, yes, we just probably, we took a fair amount of time there, but we just wanted to provide the full context of the situation of that Bloomberg story, which I think is a really, really important story, important history they went over. Before getting into the TLC insurance broker crisis and what that story is about. And so the point we're making here is that like right now, American Transit is in business. So, we want to be careful to be like, we don't want to like cause, we're not saying we even have the power to that, but obviously we have an audience and people reach out to us. We don't want to be like, Attic is out of business or, run for the hills. That's, we want to make sure that's not what we're saying. That's not what Bloomberg is saying. American Transit is insolvent, but they're solving for it. But in the meantime, the DFS, you have to assume that's what we have to assume that they're gonna make sure the situation is handled. And if not, then yes, we're gonna have big problems. But right now, if there's two options and you currently carry Attic, you know, I think the responsible advice or the responsible opinion I can give you is, if you have Attic and your American Transit policy is renewing, and it's only, that's the cheapest option, and the Hereford is either not underwriting or other insurance company is underwriting you, it's okay to renew with Attic because it is still licensed by the DFS. They're handling the situation, so there's no reason to run for the hill. And I think it's extremely important for anybody who's covering this topic not to cause some sort of panic, because that's honestly the last thing anybody needs. Okay, so we kind of provide that. We highly recommend reading the Bloomberg piece if you can. Very interesting history. But now we're getting into the main article today, and so that's NYC TLC insurance broker crisis. Now this is this is an AutoMarketplace Plus article. So this is for our we basically publish this once every 1 or 2 months. We don't have that many articles behind a paywall, but this gets very technical. And so this is part of that series. But in this video overview, we're going to kind of give you a peek behind. If you have the patience to listen to us, we're going to give you a peek behind the paywall, and talk about this insurance broker crisis and the insurance broker industry, and actually something we're soft launching today, in fact. So NYC TLC insurance broker crisis. The NYC TLC insurance market is characterized by local, often mom and pop specialty brokers. Many of these brokers operate out of a single storefront, are based in Brooklyn, Queens, and the Bronx, and employ staff who speak multiple languages. A significant portion of the for-hire driver population prefers to communicate in their native language or work with individuals within their ethnic community. So, for example, if you're, I mean, it is stereotyping, but it's actually like a true dynamic that happens. Like, so for example, if you're Spanish speaking, you might naturally prefer a TLC insurance broker who speaks Spanish. Or if you're Russian speaking, you might prefer a broker who speaks Russian or Punjabi or Urdu or Hindi or Uzbek. There's just so many, and we'll get into this, we'll share an interesting stat about that. But, so that's how the TLC insurance broker market looks. So given the TLC insurance marketplace is primarily made up of a few commercial specialty auto insurance, the American Transit and Hereford basically have the majority of the share of non-self-insured fleets that primarily operate mainly in the NYC. A lot of these brokers' businesses drive from NYC commercial fire transportation policies. If American Transit has more than 60% market share of NYC TLC insurance policies, it might not surprise you that Attic broker commissions make up a huge chunk of business for many of these local insurance brokers. So, our point here is that if Attic has this gigantic share of the market, which it does, it has between 60 and 65%, approaching 65% of the market share, then therefore it's paying the vast majority of broker fees. And there's this big market of like NYC specialty brokers that are mom and pop NYC businesses. And so if there's problems at Attic, then we're going to outline why that's probably going to cause problems at brokers, and you're actually kind of already seeing it. So that's the point there. So just to give some numbers behind it, If we do a quick total addressable market TAM analysis of the overall commercial liability insurance premium opportunity for the NYC TLC market, it would roughly look something like the below calculation. Remember, this excludes the comprehensive and collision insurance opportunity, which is like physical damage, which is for another time, and large self-insured rental fleets. So based on the latest TLC factbook data, there's about 117,000 FHVs, so policies, minus the roughly 15,000 self-insured rental fleet policies, which are serviced by basically self-insurance captives that those rental fleets manage or maintain. Times $5,000 is our assumption based on our knowledge. Average weighted policy. So an individual driver, let's say, might have a 4,200 policy, but a fleet might have a 7,000 policy. So if you kind of weight, do a weighted average of all the policies, I think 5,000 is a fair assumption. Maybe it's a little bit less, but I think 5,000 is a reasonable assumption. So doing that, the market size is about a little over $500 million of premiums. Now, using this figure, you can also estimate what TLC insurance broker revenue, what the TLC insurance broker revenue opportunity is, excluding the larger self-insurance rental companies, which we mentioned above. So there's a little over $500 million of premiums that are going to be underwritten, annual premiums, and this again based on our knowledge, the weighted average broker commission is, let's say, 8.25%. So ATIC right now pays 8%. Hereford pays, from our understanding, 9%. Used to be 10%. So if you kind of blend that market share, a reasonable assumption would be the average broker is making 8.25% broker commission. So basically, the insurance broker market for the TLC industry is a little over $40 million. So we showed the math here. Let's just go over this. So this is based on the latest fact book. So there's a little over 107,000 FHVs minus the self-insured fleets plus the active yellow cabs. Technically, this number could also go up by, let's say, another 4,000-ish than the weighted average policy. So if you do this math, you get about 510 million. Then you multiply that by the blended broker commission. So that's the TLC. That's the total premium, TLC premium mark. Basically for those like insurance executives or business people looking at this, and also for the drivers as well, and the other fleets are looking at this. Like that's about the size of this insurance market. So it's a pretty sizable niche. I mean, this is just NYC taxi and FHV insurance, and the broker in this is a pretty sizable also niche broker market. So a little above $40 million. So okay, so TLC insurance broker economics. So okay, that's the gross revenue they make. We're going over this because this is a very necessary context to quantify how we're providing kind of like in a little bit of a mini industry overview to provide context to why we think a crisis could unfold and actually quantify it for you, and also just provide you kind of information about the market right now. Based on our conversations with several TLC insurance brokers, both ATIC, the close to 65% market share, and Hereford, close to 20% share, currently pay brokers between 8% to 10% commissions on premiums that are ultimately paid or earned. So obviously, they're not going to earn the commission unless the premiums are paid. For example, if a TLC broker originated $5 million worth of TLC commercial auto, so let's say 1,000 policies at $5,000 per policy. For ATIC and Hereford, the broker's gross revenue, not profit, just the revenue they make, might look like as follows. So if a broker has a book of 1,000 policies, and again, these brokers, a lot of these brokers are like most of their revenue is coming just from TLC insurance. So this is like a vast majority of their revenue. Sorry, let me just put this light a little bit down here. Sorry about that. The sun is kind of setting, so it's messing with the lighting. So that book of business, that broker, just to illustratively show you, if they have a book of 1,000 policies and 5,000 per policies, and they're making 8.255% broker commission. So on that book of business, their gross revenue might be a little more than $412,500, as an example. Now, brokers, like many businesses, have associated costs that help them generate revenue, including staff, rent, utilities, phone and internet bills, sales and marketing expense, etc. A lot of these costs are fixed, and a broker can drive profit through scale. In other words, if a broker's overhead to service 1,000 policies is the same as 1,500 policies, the larger broker is going to be more profitable. So if you have the same, I think you get the point, but just to clarify it, if you basically have, if a broker can have the same overhead with 1,000 to service 1,000 policies, if with the same cost structure they can service 1,500 policies, obviously they're going to be much more. That's going to drive margin. So scaled brokers have an advantage. Basically, is the point I'm trying to make. So that's why when we're going to estimate the margin these brokers are making, you have to layer that on, that it varies, with scale and efficiency. So, in other words, if a broker's overhead to service, based on how efficiently a broker runs their capital structure of the debt and scale of their business, margins can vary. We estimate that a well-run TLC insurance broker should make between 25 to 35% net margins pre-tax. The owners, shareholders of a TLC insurance, TLC only or mostly, let's put mostly, insurance broker with 1,000 policies or 412,500 gross broker commission revenue should be making between 100,000 to 150,000 in pre-tax profit, assuming no debt. Remember, the more scaled and more efficient a broker is, the higher margin are likely to go. So we just kind of quantify this. So easy enough to follow: 1,000 policies, 5,000 a policy. That's $5 million. The blended broker commission of 8.25%. So the revenue is 412,000. Let's say they have a 30% net margin. So that's kind of like if let's say there's one owner, so that owner is making like $125,000 a year in this example, which I think is reasonable given, it's New York City. I don't think that's absurd. So S&P Global recently reported scaled nationally operating insurance brokers across multiple insurance lines have a median EBITDA. So EBITDA is a financial metric, earnings before interest, taxes, depreciation, and amortization. It's basically like a proxy for like earnings before taxes, you could say. Assume, interest is obviously if you have debt, that's debt expense, so taxes pre-tax, and DNA is a non-cash expense. But obviously, if you have ongoing capital expenditures, which an insurance broker won't really have, correct me if I'm wrong, they might. It might be one-off, but it's not a business in my mind that would have like a lot of maintenance capex, unless I'm missing something. So S&P Global recently reported scale nationally operating insurance brokers have a median EBITDA, margin of close to 30%. So we provided a link to this, but this isn't a publicly available, not behind a paywall presentation S&P Global shares. So you can easily access that. We provide a link to that. So, it would conceptually make sense that a broker focus on a specialty commercial auto line such as NYC TLC insurance would have similar margins. So our assumption of 25% to 35%, what we're saying is that it's, yes, like these brokers are mom and pop. They're not like billion-dollar brokers. So you'd assume that their margins might be less. But why we're saying it conceptually makes sense, because different like commercial lines and specialty lines are well known to pay higher broker fees than like, general auto or general or other insurance, where obviously, we're not insurance experts, but like life insurance brokers might make like 3% commission. We could be wrong on that, but other insurance lines might make, that are more like commoditized, might make lesser commission. But a specialty line, especially a commercial line that's local, would probably garner higher commissions, as you see with the 8.25%. It honestly could go to 10% plus. So that's where you're right. It would conceptually make sense that a broker focused on a specialty commercial auto line, such as NYC TLC insurance, would have similar margins. Although many TLC brokers don't have tremendous scale, the mom and pop owners are usually directly involved in the business, directly involved in running the business, which would drive margins higher. We're basically saying, like, let's say because it's mom and pop shops, which is really cool to see, and we love to see mom and pop shops, or like local shops, basically like single storefront shops, where if there's 3 employees and one of the employee is the owner, or the main person who's doing most of the work is an owner or 2 owners, then the margins are going to be higher, because the margin represents basically the owner's take-home pay, if that makes sense. So that's what you said. Like, the way to view this, you might say, "Oh my God, they're making 30%." You can basically say like a a person who owns a $5 million annual premium TLC insurance broker is probably taking like between 100 and 150,000 pre-tax home a year, which in New York, I mean, I think that's extremely reasonable. It's hard to run. It can be challenging to run this business, and we'll get into that. Note, the above is illustrative, and our overview in this article is not meant to be a definitive guide on the economics of a NYC TLC insurance broker. I'm sure some TLC brokers will say we are overestimating how much money they make, and they could be right for a variety of reasons, scale or efficiency or the debt they have. The main point of our analysis is to provide necessary context to the broader discussion of why ATIC's current financial situation could significantly impact the NYC TLC insurance brokerage marketplace. Okay. So we're obviously, we're like, okay, when's the main gut of like, where's the crisis? I think you got to have all of this context to really understand why we're saying a crisis might be brewing in the brokerage market. You got to have like this context. It's very important. Okay. So NYC TLC broker commissions have been cut. So we use 8.25% as the illustrated broker commission in the examples above because that represents a market share blend of what ATIC, 8% in Hereford, 9% currently pay their brokers. Based on our research and discussions, these broker rates have recently been changed. For example, our discussions with several brokers revealed that American Transit now pays an 8% commission as follows: 6.4% on paid earned premiums, and then 1.6% to bridge to 8% on year-end paid off earned policy premiums. Now you might say, okay, earning 8% is, it's 8% is 8%, but obviously that's like, working capital swings, and if they cut that, and why they restructuring it like this. Are they doing like cash flow games? So our insurance, does that imply like, they might, instead of splitting the 8%, and maybe that was even higher before from our understanding, is that like a preview of things to come? What if this becomes like 4 and 4%? Like, that has a significant impact. Hereford, we know from our understanding, has recently cut broker fees from 10% to 9%, which, you can't really blame them as well, because it is, if the main competitor, if they've had to deal with, if Hereford's had to compete with a Ponzi scheme for all these years, and now that alleged Ponzi scheme, let me put it that way, although there's, I think, immense amounts of evidence that this company has been financially insolvent for quite some time. They're going to adjust their broker fees to market. Now they're still paying above ATIC, but they went down from 10% to 9% from our understanding. Now, does that go down? And so you might be saying, okay, this is the genesis, how we're going to quantify why there is a broker crisis potentially brewing. So note, increasing premiums will offset some absolute dollar commission losses. So for example, okay, if premiums are increasing, so let's say you earn 9% commission on 5,000, that's actually about the same as 8% commission on 5,625. So, so that should be said as well. But our understanding is the DFS is not really going to improve that big of a premium jump, at least for ATIC. So as we overviewed above, if brokers net between 25 to 35% of the gross commissions they earn, any cut in the broker fee is likely to have a massive impact on their bottom line. This also excludes discussions about the increased cost of running an NYC insurance broker, staff costs, general operating cost inflation. So, to run a business, a broker is also increasing, like to, hire the employees, the other sorts of talent to maintain your infrastructure, including software systems, rent. Maybe rent in a weird way could be deflationary, but we could be wrong on that. But their operating costs are also going up. So let's use the same example we used above, a TLC focused broker with 1,000 policies. So we went over that math before, 412,000 of gross revenue, and that equates to like 125,000 of take home pay for the owners of that brokerage. So that's a 30% net margin. So this is, it might not be obvious to a lot of people, but let's say if the blended broker commission declined just 1%, in financial speak, 100 basis points to 7.25%. So you might be saying, okay, the broker fee got cut by 8.25%, blended to 7.25%, which honestly is not, it wouldn't be a crazy thing to occur in the marketplace. Everything else equal, given a lot of brokers' overheads and operating expenses are fixed costs, so like a, a lot of a lot of this cost is like fixed. It might be like having one or two employees. It might be the rent. It might be software systems. It's probably more fixed than variable. So if you cut the broker fee, that's going to flow all the way down. A lot of that's going to flow right to the bottom line, that take home number. So we're just saying, let's assume it's 1%, 100 basis point blended cut. Let's say that happens over the course of the next year, or even sooner than that, to 7.25%. Everything else equal, given a lot of the broker's overheads and operating expenses are fixed costs, this would be the impact. So same thing, 5 million, 1,000 policies, 5,000 per policy, so instead of 8.25, 7.25% broker commission. So the revenue is obviously down to 362,500, but the net margin plummets because, and the absolute net margin also plummets because a lot of the operating costs are fixed. So although 1% doesn't seem like a lot, the example above clearly shows the tremendous impact such a reduction would have on a TLC insurance broker's profitability. Net earnings dropped 40% in our example, from 123,750 to 73,750. Excuse me. So simple examples of 1,000 times 5,000, 5 million, then times 7.25% instead of 8.25%. So your revenue goes down to 362,500 from 412,500, and just conceptually, like 1% of 5 million is 50,000. So just, if you want to sense check that, I'm actually sense checking it live right now. So that's about right. But since all of these costs are, maybe some of that's variable, but a large chunk of it's going to be fixed. That's just an example of a 1% reduction in the blended broker commission these brokers will earn. That just changes the business. Now, here's a mini sensitivity table. Hopefully you did the math right. These are different. So we did from 8.2 to 7.25%. Even if you do a quarter basis cut, on an absolute basis, you're losing a lot of money, and there's not a lot of absolute dollars, to spare. I think the numbers just speak for themselves, basically. So as the analysis reveals, and if you're confused, or you disagree with what we're saying, like, let us know if we're missing something, or we've done incorrect math. So as the analysis reveals, the dire financial situation at American Transit is correctly described as too big to fail. If ATIC were to abruptly shut down without a transition plan in place, it would be a systemic event that would not only ripple across drivers' fleets and the riding public, it would also hit a sizable NYC-based insurance brokerage market very hard. How many people are employed and other businesses supported by the over 40 million local NYC TLC insurance broker market? Think about all the... We'll get into that, but we're basically saying in a 40 million... Number one, a $500 million industry employs a lot of people. It's a local, hyper local industry. So it specifically employs a lot of people probably in New York. I'm sure they outsource some of their administrative work abroad or to other cheaper places, but it still impacts a lot of people in New York. So regulators will also need to consider, and perhaps already are, I'm sure they are, the potential impact of ATIC exiting the market or reducing broker commissions to achieve better financial results. Additionally, the DFS must evaluate the implications of any new TLC insurance entrants opting out not to use ATIC's existing broker network, i.e. excluding an existing ATIC broker from a new provider's broker network. So for example, let's say you have that 1,000 policy broker who makes 60% of their revenue from ATIC or even more. let's say a new insurance player enters the market, but they have another broker network, which is fine. You can't hold a gun to their head, but that also like really impacts that broker if a lot of their revenue is being generated by ATIC, basically. So, I mean, again, we're not saying that you have to force a new entrant to use the existing broker network, but it's something you got to consider. You know, you don't want like 20 businesses or 50 businesses going bust. So TLC insurance broker market, we're almost to the end of the article. TLC insurance broker market share is not as concentrated as the insurer's underlying share of the marketplace. So obviously ATIC has 65% share, Hereford has basically of the, between ATIC and Hereford, that's the most of the market share outside of the self-insured fleets. There might be a handful of broker. We're not saying the broker market share there is not as concentrated as that. So there might be a handful of brokers who originate 5,000 plus policies, even more that have 1,000 plus policies, because like we said, there's a little more than 100,000 policies to go around. Just, you know, so like the largest TLC insurance broker might be like 10,000, 15,000 policies. And then there's like this like longer tail of other brokers. So there might be a handful of brokers who originate 5,000 policies plus policies, even more that have 1,000 plus policies in their book of business, and a long tail of brokers with between 100 to 1,000 policies. Many NYC TLC brokers offer both American Transit and Hereford policies, so there is a significant overlap in broker networks between the two major insurers. So their broker network overlaps. Note, some brokers also have income streams from selling other insurance products, including home, workers' compensation, other personal and commercial lines. So they are diversified. But that being said, based on our knowledge and our discussions, many brokers, again, mom and pop local brokers who focus on NYC TLC insurance, often generate the majority of their income from TLC commercial auto liability policies. So these TLC, a lot of the brokers we talk about like are generating the vast majority of their their revenue from TLC insurance policies, or American Transit and Hereford. We also predict, just like and we can talk about this at length later, but given the market dynamics outlined in this article, we also expect more broker consolidation, larger brokers buying smaller brokers to navigate industry headwinds. Okay, we even address, I think a lot of people have this question that like, why doesn't ATIC or Hereford just sell insurance directly? Why do they use brokers? Like a lot of people have that question. So we want to explain it at least in a simple enough, in a easier to understand uh, way, and hopefully it's easy to understand. If it's not, let us know. We'll try to clarify more. But so and this is, I know this is running long, but it is an important topic. So in a market that offers more than two insurance options, using an independent broker is useful to compare policies and coverage. In other words, as long as the commission is relatively the same across insurers, a broker, what I basically mean by that is like if one insurance is offering a broker like 10% commission and another insurance company is offering them like 4%, they're going to probably recommend the 10% commission insurer. So in other words, as long as the commission is relatively the same across insurers, a broker or comparison site could present you options and pricing from 4 to 6 different insurance companies and give you relatively unbiased advice on which policy they would recommend. So in a market that has many options, like, yeah, it makes sense from a consumer perspective, you know, why an independent broker is very useful. Obviously, the NYC TLC insurance marketplace doesn't have a lot of options. So this point is not going to be relevant for many NYC for drivers and fleets. Therefore, a question many drivers and smaller fleets often have is, why doesn't American Transit, Hereford, or any other insurance company sell their policies directly? Why do they need brokers? Doesn't that increase the cost of policies? Obviously, if the broker commission is 8.25%, that seems like it's increasing the policy by 8.25%, right? Obviously, that's not the case, and we'll explain this. The best way to think about these questions are: one, an insurance company's administrative costs and the value of running an in-house brokerage, an insurance company's administrative costs and value of using an external third-party broker network. You have to remember, insurance brokers don't simply sell policies, they have to service policies. This includes collecting monthly premiums, doing claims administrations if an accident occurs, processing driver and vehicle change requests, answering calls from customers on a variety of subjects from policy costs to other administrative inquiries. Specific to the NYC Taxi and FHV marketplace, many brokers also need staff that can speak other languages and understand different cultural norms and nuances. So according to the TLC Factbook, and we provide a link to it, the leading primary language for TLC drivers outside of English, 22%, are Spanish, Bengali, Russian, Mandarin, Arabic, Urdu, and French. That still leaves 43% of drivers of the 180,000 TLC licensed drivers who list another language as their primary language. NYC is genuinely a melting pot. Think about all those languages, and obviously, like, many people obviously understand English, but it might not be their native tongue. So as you mentioned before, they might be more comfortable or just like want to deal with someone who literally speaks their language or understands like cultural nuances or is part of their like, gurdwara or mosque or something like that. So, like, or temple, or church for that matter. I mean, it's just literally, there's just so much, there's so many, or any other religious institution that I did. And I'm sorry if I'm didn't mention every other institution I could, but basically my point is that, like, just think about this. So like, I just want to show you this. And this is in the TLC fact book. Oh. I just want to just show you the actual data just very briefly. I mean, just look at this. The diversity is, I mean, it's just astonishing. It's like genuinely only in New York City would you get this diversity. And this, if you add all these percentages up, and there's 179,357 active TLC licensed drivers, I mean, this is like every language, culture, religion, ethnicity on earth. So, I mean, you do need kind of a very unique and specialty type of broker network to service this industry. Anyways, you get the point. ATIC and Hereford have essentially calculated the cost, administration, and value of having a third-party NYC TLC broker network is worth more than the broker fees they pay them. For example, if ATIC wanted to directly sell insurance policies outside of the need to invest in physical storefronts and or digital infrastructure, they would need to hire and train more staff. When you add up the cost of running an in-house direct brokerage, it probably makes more sense to utilize a trusted broker network at this sorry about this, external broker network at this point. Obviously, both companies can experience with selling policies directly and indirect. It doesn't have to be either or. You could sell some directly, some indirectly. Another way to think about this in financial terms is in cost as a percentage of revenue terms. For example, will it cost more or less than 9% of revenue to run an in-house direct brokerage? Hopefully that made sense, but our main point in this is that like, a lot of people be like, oh, why isn't the insurance company just send like, why isn't Hereford or American Transit just directly sell insurance policies? Obviously there's a cost to make that infrastructure, there's a cost to employ that staff, there's that overhead cost that the brokers have too. And so they have determined, obviously they're in this business, that especially given the language thing and the unique nature of this industry, that it's probably more cost efficient, to be frank, to use a third party broker network and pay them 8.25% or 8 or 9% broker fees than do this in-house that might cost them more actually than the broker commissions they pay out. So I hope that answers how those decisions are made, or why it's not as simple as like, oh yeah, if like you directly sold the policies, like the policies could go down 8.25% overnight. It could actually go up if you think about it, if the in-house cost is more. Okay, so we also just want to mention this at the very end. So AutoMarketplace.com. So as many of our readers know, before starting AutoMarketplace, we ran an NYC TLC fleet focused on the NYC Uber Black market. We had an all BMW fleet. We've paid $1 million in TLC insurance premiums over several years and manage the associated administration. Every single running a fleet in New York City, a scaled up enough fleet, you will, every scenario you can imagine, I have personally dealt with, my team has personally dealt with, from a car flooding to a car getting stuck on the Brooklyn, a car getting rear-ended on the Brooklyn Bridge, to like just every single insurance situation you can imagine. I have helped fleets manage them, or my own fleet has gone through it. So we've paid for all those, premiums too. So we've also privately advised to date other drivers and fleets on the purchase of another 700,000 plus worth of TLC insurance policies. Obviously, these numbers sound big, but like it's modest. But we just kind of we just started doing this. Is my point. We know the challenges, but we do know the challenge of NYC TLC insurance in a very real way. So this is leading up to what AutoMarketplace.com is, at least how it's going to start. We know the insurance industry. We're seeing this insurance crisis take shape, this broker crisis take shape. So, given the above, instead of just reporting on the unfolding TLC insurance crisis, we're motivated to, excuse me, we're motivated to provide solutions. So, AutoMarketplace.com will provide more insight into the opaque tax inefficiency insurance marketplace. Over the past several months, the Auto Marketplace team, that's Adrian and Jason, who helped me out, has called over 20 TLC insurance brokers, identified brokers we and our clients had a positive experience with, and mapped it out. We still have more brokers to call, ratings to refine, and generally a lot of work to do on the site. So this is a soft launch, but we're now in a position to share our website and invite people to sign up. Given now insurance renewal season here, we almost want to self-motivate ourselves just to launch the site and start working on it. But we've done quite a bit of work. So please also feel free to give us feedback on the site by emailing feedback@automarketplace.com, or just giving us comments in the comment section in the YouTube, or in the Substack. So although AutoMarketplace.com has a broader vision, which we'll briefly overview in a separate video. So we're not going to give you the whole pitch right now. We think the best place for us to start is focus on the NYC TLC insurance broker market to help drivers and smaller fleet find great brokers, and vice versa. For also, like we predicted, some brokers, smaller brokers, are probably going to need to scale up, or they need to get acquired. So, the sales and marketing efficiency in the marketplace needs to improve. So we're planning to do this. So the other video actually got cut off. The microphone went out. So this is when we say sales and marketing efficiency. What we mean is that right now in the TLC insurance industry, it's very hard for people to independently find brokers, and for them to communicate with brokers, and to understand who the better brokers are, who the not so good brokers are. And so this is a soft launch of Auto Marketplace. Obviously, as you can tell from the categories, and myself, Adrian Cruz, and Jason Shaw, who are part of the team, Auto Marketplace team, we've been working really hard at this for months and months and months, including, and also, just doing a variety of things, working with developers and stuff like that. And so this is a soft launch. And so we're trying to keep everything short. We're not going to get into Web3. That's for a totally different discussion, but it's going to actually be very important to what we're trying to do with AutoMarketplace.com. So about us, before starting AutoMarket, we operated a for-hire vehicle fleet. So we'll just skip to, so Google, Yelp, and other popular online ratings are helpful, but many shops and vendors manipulate their ratings. Are there really that many 4.0 plus places to do business? Remember, many reviews are user-generated, and while useful, such a rating system can be abused. To help create a better system, Auto Marketplace created its own rating methodology based on private, verified user feedback and our own experiences. So this is our rating system. And the important thing that we're going to try to do is, if we don't have a positive experience with a broker, they're just not going to be on the site. We're not going to create a listing that gives someone a 2.0. I think that's we're not even sure what the point of that is, the utility of that, just to like say this is like a bad person or to intimidate a vendor. What we're just trying to flag, like these are the best people to do business with. And so in our book, like 4.0, like what that means is like very good. And so 3.5 is good. That means like if someone asked us if like it's in the neighborhood, if it's more convenient for someone, like they're good at, like they're a good person to do business with. By definition, like if you're 4.6 plus, like there can only be so many of those type of like that highly rated vendors. And so what we've done is, like, to be clear, these listings, so as an example, and again, we're just we have all of these categories, but we're going to launch with brokers giving us insurance renewal, and there's just a directory to make it easier for people, and we'll continue to fill this out like day by day, adjust some ratings if need be. And our ratings are our own experiences, fleets we advises experience with brokers, and also other individual drivers who reach out to us for advice on insurance, their experience. And so these ratings are based in like actual experiences, not, just like he's my friend, so I give him a high rating type of thing, but I never done business with them. So as an example, like, you know, so you can sort by different things. So, and also, this has, you can enable current location as well. Um, and search that way. But let's say, just to make life simpler, we go to TLC Insurance, and you can sort by highest rating, lowest rating, distance from where you're at. So let's click Omega, and obviously you can zoom in. And on the mobile, I honestly think on the desktop it's a cool site to use. On the mobile, I think it's even easier to use, because I understand the vast majority of people, including myself, browse the internet on mobile. But so let's say you click on Omega. So these are our own pictures. The team took them just so you have a kind of, and this is basic. We're not trying to, do something insanely complex right now. So we're gonna do a more robust profile here. So we had a very positive experience with Omega, and some of our clients did. So this is the address, this is the phone number. Now this is, remember, like this is not, Omega hasn't listed us as like we've created a profile, we created the rating. So if you do a booking request or message, like it's basically booking via us or messaging via us. There's no charge or fee like that. You just have to remember, a main reason we're fundamentally starting this site is a lot of brokers, like they don't respond to emails quickly. They don't have a website. Like many of them actually just fundamentally don't have a website. And so this is our way to make that more efficient for drivers, for fleets, for even the brokers, to help just like make the sales and marketing process more efficient. So as an example, and this is, by the way, all without signing in. If you sign in, you can easily choose a date and time, and then do book appointment, and then you can message them as well. So basically what that does is that sends a request through us or messages us, and then we reach out, and then we're going to be very quick with this to make it more efficient. In addition, in the mobile, so if you actually click Waze or Google Maps and tell us if this doesn't work, we've stress tested, like wherever you're at, if you enable the location, like if you click Waze or Google Maps, it'll actually give you directions right to that, just to make this simpler. So this is the first step of this. We're not trying to, we're just trying to, just do basic stuff that like just needs to exist, to be frank. We also have insurance services, by the way, if you need help. But basically, the main point of this site right now is making an easy to use directory. So like, and we filled out other categories too. So I think under taxi medallions, we have some listings going. Obviously, we're going to fill this more out. Taxi, some of them don't have any. I don't think we filled out black car bases yet. But this is the point of the website. Like this is a soft launch, so please give us all the criticism you can. We'll try to improve the site. But it's insurance renewal time right now. People need this on the TLC insurance side right now, in terms of, I think it'll be helpful to people. And every day we're going to update this. And if you're a TLC insurance broker and you want to be listed or reviewed, and we missed you. I mean, we've called over 20, 25 TLC insurance brokers already over the last months. Try to do this as quickly as possible ahead of the renewal season. You have this ATIC crisis. We just went over the broker crisis, so we think something like this is even more necessary, especially for brokers who either need to scale up or need to, and get more customers, or, because we think there's going to be consolidation, and also for drivers and other fleets who might not be having the greatest experience with their current broker. So this is AutoMarketplace.com. Obviously, we're gonna talk a lot about like Web3, what does that mean, and other categories. But for now, we're just soft launching this. Feel free to sign up. It's very basic, just an email confirmation. Give us all the feedback you can. And so, that's it. So thanks a lot for joining us. We hope you found the the article on kind of the brokerage industry. Let us know your comments, and we'll see you next time. Thanks a lot for joining us.